Welcome to this very special edition of The Big Question on Gold, a metal that has not only dazzled us with its beauty for centuries, but has also served as the cornerstone of financial security in times of crisis. And today, gold is once again in the spotlight as global markets react to dramatic escalation in the US-China tariff war. Just today, President Donald Trump's whopping levies of up to 104% on Chinese imports came into effect. In response, markets and investors are trying to reposition themselves as global trade tensions escalate and fears of a recession mount. Gold prices rose today as the dollar weakened. Gold prices climbed 2% overnight, reaching over the $3,000 per ounce mark once again. In India, the yellow metal has been hovering at around 90,000 rupees for 10 grams of 24-karat gold. But it's not just for today. For years, in fact, gold has been considered a safe haven asset during times of economic or political turmoil, as investors tend to flock to it when they become risk-averse and seek to preserve their wealth. The simple reason is that during times of uncertainty, paper currencies lose value due to inflation, whereas gold's worth remains resilient. This is because it's a physical commodity with limited supply and intrinsic value, making it a reliable hedge against currency depreciation and inflation. It's not just individuals, but even nations see gold as a hedge against inflation and a tool for financial stability. Central banks of countries tend to increase their gold reserves during times of global turmoil and instability and reduce reliance on foreign currencies. Gold's inverse relationship with the US dollar, which is another major reserve asset, is an added element to gold's appeal. Usually when the dollar dips in value, like it's happening right now, gold rises, enabling central banks to protect their reserves at times of market volatility. Now, the question is, will gold continue to hold that safe haven? We're asking this because with the tariff war moving on at breakneck speed, gold prices have also been pairing off. In fact, in the last week, gold has seen a 4% fall in prices with an uptick now. Can gold continue to be the safe haven asset as bond prices will also move up? That's the question we're asking our guest today. I'm speaking with David Tate, CEO of World Gold Council. David, thank you so much for your time to us today on The Big Question. And the question we've really started with is a simple one, and I'll pose that to you first. Can gold continue to be the safe haven that it has always been seen as, considering everything is upended right now? And we're seeing what's happening with bond yields in the US, for example, in the last couple of days, the reaction of gold prices.
Yeah, the short answer to this is yes. I frankly can't see any scenario on the horizon where gold should decline. Nearly every indicator I've got in my head and in my heart is pointing towards a higher gold price. To what extent is anybody's guess, to be perfectly honest. But I think you've got a collection of main drivers that are forcing the price higher. Probably the most important one, to me at least, and I think increasingly to a larger group of people, is the threats to overall global financial stability from the sovereign debt crisis. There's upwards of $72 trillion in sovereign debt sitting out there, with another 12 to 13 trillion to be added to it this year, I believe. And the last thing the world needs is steepening interest rates, steepening yield curves. And over the last 24 hours, you've seen a sell-off in US Treasuries, 10 years and 30 years, which has surprised a lot of people. A lot of it may be due to liquidation by hedge funds, but nonetheless, the yield curve is steepening. And you could argue that reflects a severe loss of confidence in the United States as a safe haven and the currency as a safe haven. Now, if that happens and continues to happen and that yield curve continues to climb, those interest rates continue to climb, the ability of the US and other countries to service their debt could become untenable. And that is what I believe has been underpinning the major gold rally over the last few years, irrespective of who has been buying it, whether that be central banks or the investor who is looking for a safe haven in the street. So long story short, yes, the safe haven is there and it's never been more powerful.
I mean, you would perhaps from your perspective say that there is no other alternative as much as gold, David, but I would just give the counter argument to what extent. People are talking about as high as $6,000 to an ounce. We've already crossed 3,000. We've seen some uncertainty in the last couple of days. Is that extent of appetite still there? And what if there is a reversal of the conditions we've seen in the last few days? You've talked about gold rally from the last few years, but the fact is all of this has become enhanced since the Trump administration has come and started this whole tariff war.
Well, to be honest, since Trump was inaugurated, I mean, gold hasn't really rallied that much. In fact, many people expected from the inauguration that gold should decline because we had a reversal of the main economic indicators that most people rely on to buy gold. And it has confounded a lot of people as to why it's continued to go up under certain sort of passive circumstances. I think the main driver has been, as I've said, central banks. We all know that. They've bought over 1,000 tons over the last 3 consecutive years. And I think the more developing central banks that have been doing this, but I think they're doing it for the same reasons that you or I would hold gold as part of a portfolio, because they run their reserves much like you and I do run our own personal portfolios, and they need a diversifier. They need something that anchors their portfolio and acts in a different way when things go wrong. That doesn't mean to say you need to have gold dominating a portfolio, but it makes sense to have it as part of a portfolio. Now, these developing central banks have obviously experienced times when their currencies have been put under extreme pressure, and it stands to reason that they will try and mimic the Western, more developed central banks. But yes, you would expect me to say it in my role. I do find myself in a position where I literally cannot see the reason for the decline, for a decline at the moment. I don't believe tariffs are the main driver here. I think they are contributing to this because they're creating a sense of unstable panic and a desire for a safe haven. But the real desire is to hedge your future state income, your personal income, with something that is not going to devalue. Fiat currencies devalue, and the more money you print, the more debt that you accumulate, the less value they become, and the more valuable gold becomes. And I believe it is this runaway threat of the inability to finance the debt on the debt on the debt that is really scaring people deep down inside. Because frankly, and I've spoken to a lot of people on this, what do we do if that happens? What do we do if the interest rates or inflation-generated interest rates are so high that the debt becomes untenable and the interest on our debt can't even be paid? It's a scary scenario.
It is a scary scenario, but the underlying assumption right now, and I know it's out there, anybody's guess, is that the current situation will reverse. There'll either be a pause on tariffs, there will be a final negotiation which makes more sense to everyone, and this will pass. You're not necessarily going to see an upending of the world order, and that's linked very closely to whatever happens with gold. I wonder, you have any thoughts there?
It's a valid point. Now, I mean, there are some people who say that this negotiating style is just a negotiating style. Go in there heavy, win something, step back. But there is also the reality that even if a small number of these tariffs are introduced, that there is an inflationary surge of some description somewhere. And I think I would argue that's relatively irrefutable. You will see one-off prices. Whether inflation rates change over time, or whether this is accepted as a one-off hit, remains to be seen. But I do think for the short term, interest rates are going to steepen, and as a consequence, you're going to see greater pressure. And the one thing which I think the US administration tried to do, which is relieve that pressure, and it's actually gone into reverse. Now, this is a market-induced steepening at the moment. Is it entirely down to panic in the financial system? No, I don't think it is, but it's going to get people thinking. And so my opinion is that once these tariff wars are over, and they will, everything passes in due course, we will be left with higher prices. We will be left with a situation where the debt is only greater, because this is going to induce a slowdown in economies. And the one thing you need to pay off your debt is growth. And as a consequence, that debt will once again come to the front of people's minds, even when this tariff stuff has been long forgotten. And the ability to finance that debt will once again rear its head. And we'll be back in a situation where people feel, uh-oh, what do we do if we cannot pay off our debts? Now, you've got Europe forced to rearm, and that's a double-edged sword. They're having to borrow to do it. They're having to create an armament bank, adding to their already immense sovereign debts. There is the contra side of that, which is if you invest heavily in the arms industry, you might just generate some growth in Europe, but it's touch and go. And as a consequence, all we really see year on year is a constant increase in sovereign debt, and with no real solution on how to solve for it, because the amount of global growth we need to pay this debt off, it just doesn't seem to be achievable given demographics and the way the world is at the moment.
So in this scenario, David, and let's look at this from the perspective of different stakeholders. I want to start with treasurers to various countries, nation states, and their central banks. What is the kind of direction that you see central banks taking as the dollar de-dollarization, as they call it, takes place? Dollar loses its faith, its value, its trust system right now. You see bond yields rising. Do you see a flocking to gold?
I think by the developing central banks, yes. I mean, if you took the Banque de France or the Fed, they have vast amounts of gold as a proportion of their reserves. Many other central banks around the world do not have those significant proportions. Now, what proportion of your reserves you should have is an open question. But relatively speaking, developing central banks have a lot less. It's worth noting that the RBI acquired 73 tons in 2024, which was 4 times up on average, just in India. But many other central banks have been doing exactly the same because it anchors their economies. They are used to runs on their currencies or non-completely floating exchange rates. And the last thing they need is an outflow of capital. So what these central banks do is they invest in gold, and it stabilizes. It gives their reserves a certain credibility. It's not just currency-based reserves, and we all sort of understand that. So yes, the answer to your question is: do I think they will continue to do that to put themselves on a more stable footing? Absolutely. Given the current situation and lack of, shall we say, reliability you have of previously reliable global partners, is the incentive to do more of that? Yes, I think so. And do they deep down inside share my same fears, personal fears, I should say, about the global sovereign debt problem? Yes, I think they do. I really do, because it's a logical fear to have, because I've not yet read from anybody, including Scott Besant, as an example, solutions to this problem.
Yeah.
And I don't believe upending the financial markets in this way is going to help one iota.
So that's one stakeholder, and very important point you made about the Reserve Bank. We seem to have come off, and by we I mean from the Indian perspective, better because of that kind of planning. From an individual, because there's a wide variety of people who are watching this show right now, David, and Indians are known to put their faith in gold. It's a cultural thing. I mean, we keep talking about how Indian housewives are the ones who seem like the smartest and wisest investors in the last year or so, compared to everyone who invests in equity, etc. There right now, perhaps people are wondering, how much higher? Should I offload some of my positions now? Have we reached the peak? How do I go ahead? If I need to buy gold, is this a good time? What would you say to some of those questions?
Well, I was a trader for 35 years, and there was never a bad time to take a profit. That is one way of looking at it. However, to your question, I refer to the very first thing I said. Although I find it very hard to pick a number out of thin air where gold could go to, because the world is a crazy place at the moment, I literally cannot see a scenario at the moment where I could confidently predict that this is a top. The opposite way of saying this is that I think there is further room on the upside, because the entire global scenario is pointing in this direction. But to move away from the geopolitics and geoeconomics just for a moment, there are a number of fundamentals that are driving the price aside from central banks. We have recently had, for instance, an enormous change in China, where the insurance industry, some $5 trillion business, has allowed gold as part of portfolios going forward. They've recently allowed this deregulated. They're allowing 1% to begin with, which is a vast number. You can do the math. I'm sure everybody can. But imagine if that's not, when the proof of concept is passed, imagine that going to 15 or 20%, which is something more normal. The numbers are enormous. We've seen a growth of the ETF industry in India. I truly believe that the younger generation in India will view gold as a safe haven, as an investment, and as jewelry. Whereas the previous generations have seen jewelry as the investment, I think the younger generations will look upon them as both as investments. And so I expect the ETF industry and the financial markets industry as it pertains to gold in India to grow enormously as well. And lastly, Japan. You've got a situation there where there are immense funds literally kept under the bed by the older generation. And that older generation are passing these funds on to the younger generation who are very tech savvy. These fund managers are now getting younger. And I do believe Japan is experiencing inflation for the very first time in nearly 30 years since I started my career. You're seeing geopolitics and geoeconomics in the region, which are unsettling as well. And so I expect that younger generation to flow into gold for very same reasons as everybody else. And lastly, in the background, we at the World Gold Council in the background are working very, very hard to digitalize both the gold ecosystem and gold in the long term, which I believe very strongly, perhaps for another time, will open gold to the asset management industry globally, where it's never been open to before. The ability to use gold and pledge gold as collateral digitally is coming by the end of this year, which will open the demand gate to gold significantly. So if you take those four things, and if you take the stuff that we spoke about earlier about the geopolitics, the debt crisis, even the tariffs on top of that, it's very hard for me to say that I don't see it going higher.
So if gold is going higher, and we spoke about it in the Indian context, I want to come to you on your view on the sovereign gold bond scheme that the Indian government put out. Now, the problem traditionally in India has been large gold holdings in physical form, shut in people's houses or banks or whatever, and assets just lying there not doing anything. The sovereign gold bond scheme was a way to get people to invest in gold. Like I said, culturally, it's a part of what we do. We believe in gold investments in a digital fashion. That's also something that the government has to pay back. The rates have been going through the roof. A bit of a tricky situation there. That's the downside, right, of finding ways to get people to invest in gold without the physical asset there.
Yes, it's obviously been a bit of a challenging time for the government having issued this bond, and then of course being caught by the price of it. Obviously, there was always that risk, and I understand that that's now come to an end. So there's going to be a vast amount of liquidation from those funds, and they're going to want to find a home. Is it realistic that those people to find a yield put it into things like crypto? I'd be very, very, very surprised. It would seem that crypto has had its day, in my opinion. It mirrors all other risk assets. As you've noticed, it's come down like a stone, and not even the US government promising to buy it has made any difference. So I would say if I were a crypto holder, I'd be panicking right now because it's just not working. So where do these people put their money? They want to invest in gold. Yes, they can just go and buy the physical. But as I've suggested earlier, I think there are great alternatives now. Finding a yield, somewhat more complicated, but as a financial asset and something that is listed, trusted, very, very liquid and easy to use to get in and out of on your iPhone, gold ETFs are, I believe, the future for the younger person. Now, you can go onto an unregulated exchange and take all the risks of buying someone's gold token, even which you or I could issue if we wanted to. But I wouldn't advise that. What I would advise is staying in the regulated space, investing in listed products or physical gold. And there are innumerable ways. I believe 18 to 20 ETFs have opened in India with our public endorsement. And I think that is the way to go forward.
Wrap this, and you spoke about younger investors and how they will look at ETFs. What's your pitch to young investors who are looking at gold versus equity versus Bitcoin versus maybe bonds, treasury, etc.? Why gold?
I would have gold as part of a portfolio. We have tested the fact that to have 7 to 10% of gold in a portfolio, an average balanced portfolio, pays off. It pays off through diversification, risk management, returns. We can just look us up and we can prove those numbers to you. The means by which you buy it, we're agnostic. We, as you know, have GLD and GLDM, which are the two largest gold ETFs, and their value is now, I think, well over $110 billion. But it doesn't matter. If people should be having gold as part of a portfolio, and I'm agnostic as to whether they want Bitcoin in that portfolio. And frankly, if you have Bitcoin in a portfolio, you have all the more reason to have gold in a portfolio as a hedge, because Lord knows where Bitcoin is going to end up. But a balanced portfolio of, for instance, 40% equity, 30% bond, and the rest split between alternatives with 7 to 10% of gold is the best balance out there. Interestingly enough, we started a fund 5 years ago, a small one, in China to prove the case that having gold as part of a portfolio would benefit your portfolio, in order that the insurance industry could take a look at this and we would put our money where our mouth is. It became the greatest performing insurance asset management fund in China, bar one, I believe. And the weighting we had was a 40% gold weighting. Now, clearly, the movement over the last few years has obviously played beautifully into that creation of that fund. And we couldn't have done it at a better time. But nonetheless, the econometrics prove that having gold as part of a portfolio is something they should all do. But I would urge, stay away from unregulated products. The risk reward is not there. Go to regulated products that are listed, buy physical gold and vault it, or go onto ETFs so you can trade it and hold it on your phone. And then you will be safe. At least the product that you've bought is safe. And then you will benefit from having that risk diversifier and risk mitigator in your portfolio.
Interesting. Thank you, David Tate, CEO of World Gold Council, there, saying that yes, gold will remain the safe haven even in turbulent times. Thank you so much to all of you for joining the show today.